Okay, welcome to the Chapter 14, Section 2, Analyzing Sales Transactions Presentation Lecture. When it comes to analyzing sales transactions, there are a couple of different terms you need to be familiar with. First of all, what is a sale on account? What does it mean to charge the customer? And then also, what is a credit card and how does it function when it comes to sales transactions? A sale on account is a sale of merchandise that will be paid at a later date. We've already talked about this. And when we have a sale on account, in this situation, it is part of our accounts receivable. Charge customer. This is the person who purchases the merchandise. So who is the customer that is purchasing these things? That's the customer whose account is going to be considered a account receivable that we will collect at a later date. And then finally, credit card, which is issued by a business to charge customer or him or her to use when making purchases. So all three of these different items could come into play when it comes to analyzing sales transactions and keeping them up to date in our accounting records. Let's take a look at the sales slip. This is something similar that a customer would receive. So in this particular example, On Your Mark Athletic Wear is the organization that is sending out the slip to customer Casey Klein. Casey Klein has purchased 1 pair of running shoes, 6 pair of athletic shoes, and 1 vinyl jacket, and the prices are indicated there on the sales slip. There is a subtotal for the amount of the items that were purchased. Then added to that is a sales tax for a total amount that is to be charged to the customer. Let's take a look and see how we are going to record this when we account for these types of sales. The account, or a new account that we have to consider, because it was indicated on the sales slip, let me go back and show you right here, sales tax, $12. We have to account for that. Sales tax is a liability. Sales tax payable is the account title. Now, sales tax payable is going to consist of all of the same characteristics of a liability. It is going to have a credit side balance, therefore to increase the liability account, we would have to credit the account. Eventually, this liability will be paid. Now, in demo problem 14.2, which we will be doing next time we meet in class, we will be calculating out the sales tax for certain transactions. So if we take fictional sales like 1, 2, 3, 4, and 5, and the number of the sale, 150, 420, 875, 1300, and 2600, and then multiply that by the sales tax percentage, which is given to us at 6%, we can then calculate out how much sales tax is to be collected, and then how much as for a total that we have to charge the customer. So relatively easy calculation, just punching some numbers in on the calculator. If you refer to the demo problems that are given to you in classroom and give this a try on your own, feel free to do so. Otherwise, we'll be going through them next time we meet in class. Now, credit terms. Let's take, for example, the exact same sales slip that we talked about earlier. If it is purchased on credit terms, which means it is purchased on account, that means that what we have to do is we have to collect the cash later. So the exact same sale, we are going to put this down into terms. So a term might be N equaling the net or total, and then 30 being the number of days to pay. So that is going to be listed right here in the terms portion of the sales slip. Now, when we sell or sell anything on account, that means that we are charging it obviously to an account receivable. That's money that's going to be collected at a later date. Now, a large business is going to have a separate ledger which is going to keep track of all of our customer accounts. Yes, we have an accounts receivable account, but if we have an account receivable account of $10,000, but we have 8 customers, we're going to want to know how much do each of those 8 customers owe us. When we do this and we break that accounts receivable ledger or that accounts receivable account into subsidiary customer accounts, that is known as creating our subsidiary ledger. This is a book that's going to contain detailed data summarized to the controlling account in the general ledger. Now, the summary appears in the accounts receivable account in the general ledger. That is our total amount that we are owed from all of our customers combined. Accounts receivable is then known as the controlling account. Now, the controlling account, we take a look at how do we know if the controlling account is correct? We know this because the balance of the controlling account is going to equal the total balances that is owed to us by all of our customers as they are listed in our subsidiary ledger. All right, well, as we move forward with this, you'll get practice with this, and it hopefully will make more sense as to how all of these numbers come together and how the checks and balances fit right into the process itself. All right, so the accounts receivable ledger, let's move a little bit further. This hopefully will be a nice graphic to help you grasp exactly what's going on here. Accounts receivable being the controlling account, $10,000 is what is owed to us by our customers. However, the controlling account itself does not tell us what each customer owes us. That is broken down into our subsidiary ledger. That is where we list all of our customers and what they owe us. So in this case, Josh Brown owes us $2,000, Jillian Clark owes us $3,000, Jason Green owes us $1,000, and Sarita Perez owes us $4,000. The total of what all of those customers owe us is $10,000. Therefore, the amount in the subsidiary ledger is going to equal the amount in the general ledger, matching the controlling account accounts receivable. Now, the accounts and how they're going to look in the ledger form of the subsidiary ledger are very similar to what we've seen in the general ledger. In this case, we would list the name of the customer here. We would list their address. This is all the information of our customer. And then as transactions on account take place, which means our customers buying things from us on account, we would then put it in our journal. And then after we post the transactions from the journal, we would post it here. So on January 1st, for example, post reference journal page 1, this particular customer bought, let's say, $1,000 worth of merchandise on account. Therefore, they owe us $1,000. If payment was made, then we would select the date here, say January 15th, post reference journal page 1, and it's a credit of $1,000 because we have now received payment. Therefore, this customer would now owe us $0. Let's take a look at recording sales on account. If we had the sales slip on December 1st, on your mark sold merchandise on account to Casey Klein for $200 plus sales tax of $12, sales slip number 50. This is the exact same sales slip that we looked at for the cash transaction. So the question then becomes, what are the 4 accounts that are affected? Well, if we take a look at this, this is the transaction clue as it's stated here. The 4 accounts that are affected are accounts receivable because $212 needs to be collected from the customer. Of that $212, $200 of it is sales of merchandise, $12 is tax, and $212 is the amount that is owed to us by customer Casey Klein. Now, to journalize this transaction, it would look like this. Let's say, for example, we are in journal page 20. So on December 1st, accounts receivable / Casey Klein, because we have to indicate now which customer is making this purchase or we are selling to, $212. Sales of $200, sales tax payable, $12. Sales slip 50 is the source document used to transact this transaction. The slash here in the post reference column is going to indicate that this number 212 has to be posted in 2 places. It's going to have to be posted in the accounts receivable controlling account and our subsidiary ledger account, Casey Klein. So demo problem 14.3 is listed here. We will be going over this problem next time that we meet in class. So if you have the demo problems printed or you have them handy, give this transaction a try. And we can compare what you have come up with when you transact this next time we meet in class when we do this one together as guided practice. Sales returns and allowance. Anytime that we have a sale of merchandise to a customer, there is a possibility that that might be returned to us. So sales return is going to be merchandise returned for credit or a cash refund. Now, a sale allowance, which is different, this is a price reduction granted for damaged goods kept by the customer. So we might have discounts or price reductions based off damaged goods, or we might have an all-out return. Either case, these have to be transacted and they have to be accounted for. So in this case, we have what's called a credit memorandum. This is the source document that's going to be used in these cases. A credit memorandum from customer Gabriel Ramus, I believe is how you say his name. He had submitted a credit memorandum to us for an athletic suit for $150, and of that $150 that he paid, he was charged $9 of sales tax, meaning the total credit needed is $159. So the question then becomes, is when we have this credit memorandum in our possession, how do we transact it and account for it in order to update our records? The sales return and allowance account is going to summarize the total returns and allowances for damaged and defective, also possibly unsatisfactory merchandise. If the balance of this account is large, we might have merchandising problems. So here is where, once this is accounted for, the balance of this account is going to be able to drive data-driven decision making, in which case there might be a problem in the process that needs to be addressed and fixed. When we take a look at the sales return and allowances account, these are contra accounts. Sales return and allowances is a contra account, which means it is a revenue account. However, it is going to have opposite characteristics of a revenue account. The sales account is revenue with a credit side balance, but sales returns and allowances is a contra credit account, meaning it's going to have a debit side balance. Cash refunds, if a customer receives cash instead of credit. So let's say, for example, they make a purchase, but they want a cash refund, they don't want credit. We would do this, and cash in bank is credited, not accounts receivable. So let's take a look at this. Here's the credit memorandum for the athletic suit. Let's say, for example, we have to now give a cash refund. What is this going to look like? Exact same source document that we had in the previous example. So in this one, we are going to credit accounts receivable for $159, and then we would also have to credit our customer account of $159. That is going to equal the sales returns and allowances of $150 worth of merchandise that was returned, and then we also have to refund the tax that was paid, which was $9. So the transaction would look like this in the journal. We would debit sales returns and allowances for $150. We would debit sales tax payable for $9. Thus, we would credit accounts receivable and our customer account, Gabriel Ramus, for $159. This transaction would have to be posted in two places, accounts receivable and Gabriel Ramus, keep saying his name incorrectly. Credit memorandum number 124 is our source document. We will get into posting these transactions at a later date. Demo problem 14.4 consists of a practice problem in transacting a cash refund. So I'll go ahead and give this one a try. We will be going over this problem in guided practice next time we meet in class. And following this, we have the posting process. This is what the posting process would look like. Notice how we have the transaction here. The posting process would go into the different accounts. Here is our accounts receivable controlling account, which is then broken up into our individual customer accounts. This is our subsidiary ledger accounts. That way we can keep track of the accounts receivable as well as how much is owed to us by each individual customer. This concludes the Chapter 14, Section 2 presentation lecture. Please make sure and review it and complete the notes. And I will see you next time we meet in class. Before I post on Classroom the next presentation lecture, which is Section 3 and Analyzing Cash Receipts Transactions.